What's up, folk? Zick back in the cockpit. Week of April 20th through 26th, and somehow this market just refused to stay scared. Quick teaser. Strait of Hormuz, still effectively closed. Oil, ripped. Intel, dropped earnings that broke the chip floor and lit the whole semi-sector on fire. The S&P 500 and the Nasdaq closed Friday at brand new record highs, while a literal naval standoff played out in the Gulf. And Ethereum? The foundation decided this was a great time to dump 10,000 coins. Casual. So we've got a war premium baked into oil, a record high tape, and a Fed about to walk into FOMC with all of that on the desk. Let's start where it all bends. Macro. Macro this week was basically one story wearing three hats. The hats were the Fed, the labor market, and oil. The story was, pick your inflation poison. Start with the Fed. Light week on the calendar, Governor Waller showed up at Brookings on April 21st with a speech called Modernizing Reserve Bank Operations. Plumbing talk. Reserve mechanics. Important if you build the rails, less important if you just trade on top of them. The actual signal lives next week, because the FOMC meets April 28th and 29th with a press conference Wednesday at 2:30 Eastern. Powell is going to walk into that room with crude up violently on the week and a Strait of Hormuz that is, technically speaking, closed. Good luck threading that. Labor. We got the weekly jobless claims print on Thursday, and it nudged higher. Nothing dramatic. Claims are still in a tame range, but the 4-week average ticked up and the trajectory is no longer the one-way grind down we saw earlier this year. File it under softening at the margins. Then oil. This is where the macro tape actually moved. The Strait of Hormuz remains effectively shut. The U.S. Navy has been targeting vessels laying mines in the waterway, and U.S. forces boarded a sanctioned Iranian supertanker in the Indian Ocean. Both Brent and WTI booked a massive weekly gain, the kind you don't see unless something is genuinely broken on the supply side. When the Middle East sneezes, oil gets a fever. This week it had pneumonia. So put it together. Crude up violently. Claims drifting up. A Fed that wants to cut but now has to explain inflation that just got a fresh oil shock injected into it. Real yields stayed firm because that's exactly the cocktail real yields like. Bottom line for macro. The easing path got harder, not easier this week. Powell does not get to ignore an oil shock of that size. Neither do you. Crypto next. And crypto this week was a tale of two coins that decided to live in completely different markets. Bitcoin closed Friday at $77,445, up 0.41% on the week. That is, in technical terms, a yawn. BTC chopped in a tight range, refusing to break out, refusing to break down, just absorbing every Hormuz headline like a sponge with no opinion. Risk on day? BTC barely moved. Risk off day? BTC barely moved. When oil is up double digits and equities are punching record highs, sitting in a 40 basis point weekly range is its own kind of statement. The statement is, the FOMC is in 3 days, and nobody wants to make a move that gets stop-hunted by Powell's opening sentence. Ethereum had a different week. ETH closed at $2,315.51, down 4.36% on the week. And the source of that bleed was not a hack, not a regulator, not a macro crash. It was an own goal. The Ethereum Foundation publicly disclosed an over-the-counter sale of 10,000 ETH at $2,387 a coin on April 24th. Yes, the people who run the project sold a chunk into a market that was already wobbly. OTC, technically, doesn't print on the order book, but the optics print on every chart. Bid-side enthusiasm wilted. ETF flows have been weak. The DeFi hack hangover from earlier in the year is still in the back of every allocator's mind. Add a fresh disclosed foundation sale and you get a 4 handle on the move-down column. The BTC-ETH ratio basically blew out wider for the 5th or 6th week in a row. And the ETH leveraged long crowd is starting to look like the guy at the bar who keeps insisting tonight is finally his night. Now gold. Gold had a bad week. Yes, gold, the safe haven, the war premium asset, in the middle of a literal Strait of Hormuz crisis, fell. The reason is straightforward. Oil-driven inflation just lit the fuse on real yields. Higher real yields are kryptonite for gold. The market's pricing the Fed staying tighter for longer because it now has to fight a fresh oil shock. And tighter for longer beats safe haven bid every time. Sometimes the market is very, very simple. So crypto was bifurcated, gold was disappointing, and the only true safe haven trade this week was buying actual physical oil tankers. If you have a fleet, congratulations. Now equities, because this is where the week got genuinely funny. The S&P 500 closed Friday at 7,165.08, up 0.55% on the week, and yes, a fresh record high. The Nasdaq Composite finished at 24,836.60, up 1.50%, and also a record. Just casually printing all-time highs while warships are maneuvering in the Persian Gulf. That's the kind of decoupling that makes risk managers reach for the antacids. The fuel was almost entirely one ticker, Intel. INTC dropped Q1 earnings Thursday after the bell, and the numbers were not, quote, good. They were ridiculous. Analysts had Intel printing a loss. Intel printed a clean profit. The data center segment grew double digits year over year because AI demand is pulling CPUs off shelves faster than the company can ship them. Friday INTC ripped, the kind of single-day move that gets old-timers texting their group chats with words like, since the 80s. The chip rally did not stop at Intel. AMD ripped right alongside, on the read-through that if Intel's CPU business is supply-constrained, AMD's pipeline gets validated by default. NVDA tagged along, because of course it did. Megacap AI tape painting at its purest. The whole semi-complex closed the week green, and looking very pleased with itself. Trader meme of the week, the guy who bought puts on Intel for the earnings print, watching his position evaporate in extended trading, while the stock prints a green candle the size of a fence post. Just sitting there. Refreshing. Waiting for a bid that never comes. Eventually, he closes the platform and goes for a walk. The walk does not help. Beneath the chip pylon, the breadth picture was uglier. The Dow actually slipped on the week. Oil-sensitive industrials and defensive consumer names got nothing, while a few megacap names did all the index lifting. So when you see S&P at record highs on Twitter, just remember, a record high index can still hide a lot of red underneath. The takeaway on equities, this was a tech and semis week full stop. Megacap AI leaders carried the indices into uncharted territory. Breadth was thinner than the headline gains suggest, and the rotation that finally showed up is the one nobody outside of Silicon Valley was asking for. If you own chips, you ate. Pick your barrel. All right, 3 trade ideas for the week ahead. None of these are advice, these are setups Zick is watching. Risk manage like an adult. Idea 1. The semi-momentum trade is loud right now. After Intel's print, the entire chip complex is in a euphoria phase, and euphoria phases tend to overshoot before they exhale. The play here is not, quote, chase INTC at the highs. The play is to wait for the first red day in the SOX or in NVDA and see if the dip gets bid hard, or whether the bid disappears the second the chase crowd loses interest. If buyers show up on red, you are still in trend. If they don't, the rally just ate its own seed corn. Watch the reaction to the FOMC press conference Wednesday. That's where the test will come. Idea 2. The oil play is screaming, but it's also the most crowded trade on the tape right now. Anyone who saw the weekly oil chart went long energy by Monday, which means the easy money is done. The interesting setup is the de-escalation trade. Calls or shares on names that get crushed if any kind of credible diplomatic framework gets announced. Think airlines, transports, beaten-up consumer discretionary names. Pure asymmetric. If the strait stays jammed, the trade just bleeds slowly. If the strait reopens, those names get a violent unwind rally. Define your downside and let the optionality work. Idea 3. The BTC range trade. Bitcoin sitting flat into FOMC with a 40 basis point weekly range is the universe handing you a setup. You don't have to predict direction. You just need to recognize that volatility is compressed, and the catalyst date is on the calendar. Straddle, strangle, whatever fits your platform. Let the FOMC pick the side for you. 2 more memes for the road. First, the trader scrolling crypto Twitter, watching ETH bleed, going, "No, but the next leg up is this week," for the 7th week running. Eventually, his portfolio is just one big ETH bag and a Discord subscription. Second, the macro tourist, 3 months ago screaming about deflation, this morning posting, "Actually, I always said inflation would be sticky." Conviction is fluid. Charts are forever. That's the week. Hormuz on fire. Intel rewrote the chip narrative. ETH disappointed. Gold disappointed harder. And Powell walks into FOMC with the worst possible Tuesday night briefing book. Stay sharp. Manage your risk. Don't marry a thesis. What stock are you buying?